Folks, we have an agenda in front of us. I'd like to get a motion to adopt this agenda for today. Can I get a motion, please?
So moved.
May I have a second?
Second by Bill.
Thank you, Mr. Condon. All in favor, please say yes.
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 All right, we have an agenda that we are operating by today. Thank you all. Next up, you all should have received and hopefully reviewed the minutes from the June 2021 meeting. May I have a motion to accept those, please?
So
I move. Ron.
Thank you,
A
Ron.
second.
May I have a second?
I'll second.
Thank you, Rebecca. Any discussion? Hearing none, all in favor of approving the minutes for the June 30, 2021 meeting, please signify by saying yes.
Yeah.
Yes.
Anybody opposed, please say no. It carries. Minutes are approved. Next up on the agenda is the chair's report. We are going to do the introduction of a new commissioner, and I'm going to turn this over to Mr. Hitchcock and let him do the introductions. Mike?
Thank you, Mr. Chairman. It's my pleasure to announce that we, and I think everybody knows this by now, but we do have a new commissioner, Melissa Missy Schumpert. Missy was appointed by Chairman Merle Smith, the House Ways and Means Committee, to succeed Alan Gillespie. She is a CPA who spent a significant portion of her professional career serving as the Director of Administration for the McNair Law Firm, which is now part of Burr & Forman. In this role, she served as a member of the senior management team for McNair. She's managed all the financial, human resources, IT, knowledge management, and administrative personnel and functions for all the firm's many offices. She's also served on the retirement plan committee, which included establishing and monitoring compliance with the plan's investment policy. And she served a very crucial role in the successful integration of McNair with Burr & Forman to facilitate their merger. And she is now responsible for the administration of the firm's 8 offices across the Carolinas. I mean, I can't personally imagine what it takes to be responsible for 8 offices worth of lawyers. So she definitely comes to us certainly with the ability to solve problems and manage personalities. So we are very fortunate to have Misty as a new commissioner. Looking very much forward to having her on the commission and her participating. And I know what she's going to bring to the table for us is going to be very beneficial for the commission and the organization. So welcome very much to Missy.
Thank you, Mike. I'm honored to be here, and I look forward to working with all of you and continuing to learn more as I work with you and attend more of these meetings and read more of your materials. So thank you.
Yeah, no shortage of things for you to read. So definitely. So, but again, welcome.
Well, Missy, thanks for agreeing to serve, and welcome.
Thank you.
Looking forward to having you on the commission. Okay, with that, we're going to move on to the committee reports. Let me recognize each of the committee chairs. Let me start off with Dr. Wilder, who's the chair of the Human Resources and Compensation Committee. Anything to report, Dr. Wilder?
Yes, just a brief report that the Human Resources and Compensation Committee has met twice since the June commission meeting. At our August 25th meeting, we were briefed on updates regarding the staff and on the implementation of the variable compensation plan that the commission approved at our June meeting. At our September 20 meeting, we moved into executive session to discuss the evaluation of the CEO and to discuss his salary. This part of the committee's report will be presented later in the executive session of today's meeting. Thank you.
Thank you, Dr. Wilder. Rebecca, I would like to recognize you as chair of the Audit and Enterprise Risk Committee. You have anything for us today?
Thank you, Mr. Hancock. Yes, well, we met on August 17th, and has been a report posted to Watchdocs, and that should be in everybody's material. And I would be happy to take questions if anybody has any.
Thank you very much. Any questions? Hearing none. We're going to move right along here this morning. Item number 4 on our agenda. I'm going to recognize Mr. Michael Hitchcock for our CEO's report. Mike?
Thank you, Mr. Chairman. The first item for consideration by the commission today is it is time for us to submit our annual budget recommendation. I think you will see that it is what we're requesting is substantially, well, basically identical to what we requested in the past couple of years. I think this is another year where we can, we can continue with the same amount of authorization requested. There's really no reason to change the amount of FTEs that we have requested at this point. I would say just caution in the next couple of years. I think, we have plenty of room in the budget right now, but we may be in a couple of years in a situation where we may need some additional authorization when it comes to personal services, but we are not presently butting up against that ceiling right now. So I will just briefly go through the presentation. This is something that I think everybody's seen many times is our organizational chart. You can notice the present vacancies that we have are in private equity, in the private equity asset class. Also we have vacancies in the junior analyst program, but those are to be expected because that is a continually kind of rotating program. So just to give you an idea of our appropriations history, back in FY17, that was the highlight, the high point for our authorization, where we were appropriated about 17 million, a little bit over $17 million. Over the course of several of the next years, we did actually ask for reductions in the appropriation to the tune of about $2.5 million. We've maintained the same total level of appropriation since FY20, and for FY23, again, we're just asking for the same amount of authorization. It's always helpful to remind ourselves and the governor's office and the General Assembly that we are in the Appropriations Act. We are authorized funds. We are authorized to expend trust funds to operate. We're not supported by any state general funds or other funds at all. Some of the additional expenses that we have going on this year, filling our open FTE positions. We also are anticipating that there will be some costs associated with the fiduciary audit that will be required next calendar year. I think, as everyone's aware, the law requires us to undergo the statute requires us to undergo a fiduciary audit once every 4 years. We are now back at that point again. It doesn't seem like that's necessarily possible, but time has moved that quickly. So that will begin, the search for that will begin in the beginning of the calendar year. We would anticipate that there'll be, and the cost associated, even though the state auditor is the one who selects the fiduciary audit firm, the costs for that are borne by us. So we would assume that there would be some costs that we would have to associate with that in the beginning of next calendar year, but still within our fiscal year. We still have some continued expenses associated with the build out of our CRM system.
Mike, this is Bill. I have a question.
Yes, sir.
On the fiduciary audit, we've had Funston for two terms, so 8 years, and they've been very valuable. My personal opinion is I'd love to see or get the opinions of somebody else. is it going to go out for bid, or do you know what the state auditor
Mhm.
is planning to do to select
Yes, sir.
somebody?
Yeah, so they'll do an the state auditor will do an RFP. They'll collaborate with us to a degree on helping, build out the scope of the RFP. That's what they've done in the past. But ultimately, they are the ones who make the selection. Bill, I'm not really sure necessarily how deep that bench is for fiduciary audit firms.
Yeah,
I mean,
I don't
I
know.
certainly, yeah, I certainly understand what you're saying, that it might be interesting to get a look from somebody different at this point. But I don't know how, necessarily what the market is, as far as fiduciary audit firms go. But to a certain extent, it's a little bit, the selection is a little bit outside of our control, but I certainly understand what you're saying.
Can you express to the state auditor that at least one board member,
Oh,
would
yeah.
like to seriously, make sure he considers others?
Sure, certainly. Yeah, we can definitely pass that along. Yes, sir.
All right, thank you.
Yes, sir. Just to give you, our budget is basically broken down in toto to about 5 lines, but these are the kind of the 3 parts of it. Personal services is the biggest item, and that's 7.2 million, followed by operating expenses of 6.1 million, and then the employer contributions, which are the employer contributions for retirement and healthcare and those types of things, at 2 million. And those numbers have remained the same for several years. Kind of the summary, we're requesting the same budget amount as, for fiscal year 21-22. We're not requesting any additional FTEs for the next fiscal year. We're planning on filling the FTEs that we have available. We're going to fill the ones that we feel like we need to serve the needs of the agency. But we don't really, at this point, don't see any need to ask for any changes to the total amount of FTEs. And I would actually like maintaining a degree of flexibility when it comes to that. So this is just to give you an idea where we are. We've got 51 authorized. We're 10 that are vacant as far as FTEs go. We set aside 2 for private equity, of those 4 for junior analyst, and then we have an additional 4 vacancies. But again, like I said, I prefer to maintain a degree of flexibility. We only have 1 impending retirement in the next 5 years. So what you see on this slide is a proviso that has been in the budget for several years. It's been in the budget ever since the contractual, the control of the contractual relationship with the custodial bank was shifted to us. And this proviso basically exempts us and PIBA from the procurement code when it comes to dealing with the custodial banking relationship. We have used this very much to our advantage by being able to negotiate a suite of services with the Bank of New York. And it has proven very successful for us and a benefit, so that we were able to negotiate with them directly and add services without necessarily having to go through the entire RFP process again. We have realized significant savings by consolidating services with the bank. So we're just simply asking, in case there are any additional services that we may want to contract with them for directly, we're just asking to retain this proviso. So, but this has been in the budget for several years. And that is all I have. Certainly willing to answer any questions in regards to the budget. There is a motion, Mr. Chairman, whenever the commission is ready to consider it.
Okay, if there aren't any questions for Mike, are there any questions?
Yeah, Mike, this is Ed. Just one question. The categories that you mentioned within our budget, have those, have the categories changed at the expense of any others? Because you said the total has pretty much remained the same, but have any of the items within the budget changed to any degree?
I think that there was over the past couple of years, and I can't pinpoint it exactly, but I think we've had an increase on the personal services portion of the budget, just because, additional costs associated with retirement and healthcare. But nothing, there's been no meaningful change in those three categories that I talked about. And nothing that we see as currently as a ceiling that we're butting up against in either one of those. And that we do have a little bit of discretion to move from one category to the other if need be, but that's not something that we've had to do in any time that I can, in recent years, certainly.
So the employee contributions, from what you're saying, have not changed over the last few years then?
Well, they've gone up a little bit, but nothing significant that we haven't been able to, to adjust. So like, for instance, the amount that we've have paid out in that regard has fluctuated a little bit. But it's nothing that we haven't been able to manage, and it's been within the amounts that we've requested. So, but the actual amount that we've expended is gone up, but then it's fluctuated a little, as with salaries too, because people come and people go and, that kind of thing. But there's nothing there's no substantial change in anything over the past several years.
Thanks.
Yes, sir.
Any more questions regarding our budget recommendation? Hearing none, Mr. Hitchcock, would you mind reading the motion to come before us?
Sure. Yes, sir, Mr. Chairman. The motion is the commission authorizes the CEO to submit a proposed FY 2023 detailed budget substantially similar to the draft budget presented for inclusion in the governor's annual budget.
May I have a motion, please?
So moved.
Thank you. May I have a second?
Second.
Thank you. Any further discussion? All those in favor of this motion, please say yes.
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 Anyone opposed, please say no. The yeses have it, and the motion carries. Mr. Hitchcock, next up on the list is some commentary on the delegation policy update.
Yes. Thank you, Mr. Chairman. And just for the kind of give some background, and I wanted to take a little bit of a slower walk into this because I wanted to make sure, especially for, for Missy's sake, and because this is not necessarily something that she's lived with, but just to give a brief history of how we, got to the point where we had a delegation policy, and that authority was delegated to the final authority to invest under certain circumstances was delegated to staff. Prior to the 2017 pension reform legislation, under, our portion of the code that governs the commission, there was a provision that said that the commission could not delegate its final authority to invest. And as a result of that, anytime that we wanted to commit capital, regardless, pretty much regardless of the amount, with a manager, with an outside investment manager, then we would have to bring that recommendation to the commission, and then the commission would vote up or down on that recommendation, and then we would at that point really kind of, we did performed all the applicable investment due diligence, operational due diligence, and preparing the recommendation before the meeting. And then subsequent to the meeting, that was when we really, negotiated more and really got serious about negotiating the legal terms and the various and sundry, documents that it takes to close an investment. And what we found is that, kind of from stem to stern, from, inception to getting something closed completely would take about 6 months. with kind of the arbitrary in the middle approval of the commission. And this was not an ideal process or time frame for dealing with managers. It was very difficult for us to make first closes. And a lot of those times you would be able to, by making a first close, you can get certain concessions when it comes to fees, and there's benefits to making a first close. And what we also found too is, once the commission approved an investment, it became a little bit more difficult to negotiate with the manager at that point. Because there's just this sense that because the commission approved it, then it was our job just to go and get it done regardless. So during the pension reform legislation, we asked the General Assembly to consider delegating within constraints that final authority to invest, which would allow staff to close an investment with an investment manager without having to take that investment to the commission and get it approved, but that authority would be limited to a percentage of assets under management regarding, and the difference would be in the amount of assets under management that the investment could encompass would be based on how liquid the investment was projected to be. So ultimately, what the General Assembly passed was a provision that allows the commission to delegate its final authority to invest for up to 2% of the plan assets if there is a reasonable expectation that we could get liquidity within 90 days or less. So, that's basically all of our public markets investments. And then as far as if there was the expectation of liquidity of 90 days or more, then the limit would be 1% of assets under management. And then as part of that statutory framework, an additional oversight function was that that we as staff would have to notify the commission of making an investment pursuant to the delegation policy no later than 3 days after making the investment. And then that we would discuss the investment with the commission at the subsequent meeting. In adopting the policy, the commission made a few adjustments and didn't quite use all of necessarily the authority that it had to delegate under the statute. It did delegate in the delegation policy, authority to invest in liquid assets for up to 2% of plan assets. But when it came to the private markets assets, it limited it to 75 basis points. The commission also decided to carry over the 3-day review period that the 3-day review period that we were previously operating under, where we would post all the legal documents and due diligence materials and accompanying materials for the commission's review for 3 days prior to the investment closing. So that is how we have been operating under the delegation policy for the past 4 years. I think there's been some, we've had some interest from the commission and a few commissioners in particular about revisiting some of those requirements. Mr. Khan and Jeff and I met earlier this week, and we went through, in particular, we went through some of his concerns, tried to capture those in a potential amendment to the delegation policy that I was planning on going through with you now. So, I sent this to you last night, and it was a little late. I apologize. It was just a little. I wanted to make sure that Jeff and I were able to meet with Mr. Condon and to really take into consideration his thoughts, because he's had a particular interest in that. We weren't able to do that until earlier this week, given that I was on my trip to Egypt. So I want to go through the proposed changes with you, unless there's, uniform agreement to move forward, not pressing, not necessarily pressing this forward. I want to make sure this is right rather than done. The changes are not necessarily too significant, but they're significant enough that I think that careful consideration of changes. We think that the delegation having the delegation has proven very successful. It's given us the opportunity to move with the speed that we need to move at in order to get investments closed without sacrificing any of the due diligence that we have always employed in trying to make sure that the investment was right for us. I think the other benefit is, because we don't have that arbitrary step with the commission approval, there's no fall off in our ability to continue to negotiate with the investment manager, because ultimately it's not done. The investment's not done until Jeff gives his approval and I give mine. So there's no point in time at which the investment manager believes that they can gain an advantage in negotiations. So sorry for the long-winded intro, but hopefully that sets the tone for what we're talking about. What you see right now is there is a clean copy of how, if the commission were to accept these recommendations, of how the policy would read. But I'm going to skip down to the strike in the black line version and go through the changes. Certainly willing to answer any questions as we go. And if you look on your screen right now in the first, in subsection A, the first change is just something very simple. Just wanted to make sure that the code reference was uniform. That's just cleanup. And in the second proposed change, what you see is the policy, when we adopted it, we put in some language indicating that co-investments would be treated the same as any other type of delegated investment under this policy, and would have to meet the same requirements. Subsequent to that, though, we formed the Grosvenor co-investment partnership, and we closed a significant amount of co-investments on that platform, both from our deal flow and from Grosvenor's deal flow as well. The commission adopted, that was something that we took to the commission. The commission adopted not only approved the partnership, but also adopted the process. So we have been, treating those co-investments that we make through that process pursuant to the approval of the commission. Also, many times when we do a fund investment, we also set up co-investment vehicles that are attached or alongside the fund investment, and those are handled pursuant to the terms of the agreement that we have with the manager. We just wanted to make sure that, given that we have been treating the practices over the past several years has been to treat those co-investments pursuant to the processes by which we have agreed to with those partners, that I'm just basically enshrining that practice into the policy. So just making it clear that a co-investment made outside of a partnership. So if it's, and this would be if we had a manager that we had no existing relationship with that brought us a co-investment and wasn't pursuant to either we weren't doing it in a co-investment vehicle that we already had established, or we weren't doing it on the GCM platform or any other platform that we established, that then we would treat it as a delegated investment. So I just want to make sure that the policy matches up with the practice, and that we're clear and transparent about that. So that is the purpose of that change. If we go down into subsection B, wanted to go to little one. The these are the 1, 2, 3, and 4. These are the exceptions to the delegation policy. And the way that the first exception read was that we could not do an investment as a delegated investment if the investment is the initial investment in a new asset class. You know, when we adopted the simplified portfolio and adopted the readopted the SIOP and combined it with the AIP, we made it clear in that document that the asset classes that were listed in table 7 in section 3 of the consolidated AIP SIOP and portable alpha were the only asset classes that we could invest in. Any other investment in any other asset class then would take the approval of the commission. I just wanted for this exception to match up with that. So in essence, what it's saying is we can't make an investment in an asset class that's not already authorized by the AIP SIOP. So same intent, but just I think a more uniform way of approaching it. There's no questions. Moving on to subsection 2. I think there's been some concern about the language as it had existed. That in the language as it used to read for this exception was that the majority of the underlying assets comprising the investment had not been previously included in the investment portfolio. I think there was some concern about the clarity of that language. The intent has always been, and the way that we have interpreted that policy, and as to what that exception means, is that if the types of assets that we're contemplating that will comprise the investment have not been in the portfolio before, then we would have to bring it to the commission. So this is just an attempt to clarify that language and make sure that the language matches up with the way that we've interpreted it. So we believe that addresses that concern. Any questions? Pause for a second and ask if there's any questions so far. All right. You will see in the next, under subsection C, you'll see some changes to the asset classes. And all I'm doing in that part is I'm just ensuring that the asset classes that are listed match up with the ones that are authorized by the SIOP. So that's just an update to recognize that the portfolio has changed from the 18 asset class complex portfolio down to the 5 asset class plus portable alpha portfolio. Moving to subsection E, and this is probably the most substantial change. I alluded earlier to the fact that under the statutory requirement is when we make a delegated investment that we notify the commission no later than 3 days after closing the investment. And as I said, we carried over the 3-day review period from our previous practice. But I think that 3-day review period has caused some commissioners a little bit of confusion and a little bit of consternation as to what it means and what their responsibilities are in that 3-day review period. I don't think that there's really never been an intent to give the impression that the commissioners were supposed to either I guess accept or reject or in some way weigh in either affirmatively or negatively on the investment in that 3-day review period. But I think it does create the impression that there is something that's supposed to be done. Not that we're certainly not willing to do it, but one of the things that this 3-day review period does require for us is it does require a substantial amount of additional work and document production in order to do the 3-day, in order to accomplish the 3-day review period. To a certain extent, we've a little bit over policied this a little. From my perspective, the additional documentation that we create has, I think, led to, it's just created more opportunity, I think, for there to be inconsistencies, because some things, and it's just it would seem that the usefulness compared to the amount of work that is done to do it is not necessarily value add. So what we're proposing is that this notification requirement much more follow what the statutory requirement is, and that commission would have to be notified of an investment made pursuant to this policy no later than 3 days following the closing of the investment, which again is what the statute requires. And that the notification would have to include an executive summary, which is what we do now, and provide access to any of the following documents that staff relied on in making the investment. That would include the due diligence report, the operational due diligence report. We're recommending that we take out the key term sheet, which is also the legal certification. And the reason that we had that, and that was carried over from the previous practices, the legal cert and the key terms sheet was, the commission would approve an investment in concept, and then we would go negotiate the contract, which would be the binding document. And then that legal certification, the intent of that was to ensure that the final contract matched up with what the commission actually approved, because there was that gap in time. With the approval now, final approval now resting with Jeff and ultimately me, there is no gap in time. So there can be no difference between the contract that ultimately I sign and is approved. So we believe that carryover, is no longer necessary. The rest of we also would, require access to any memorandum or reports of the general specialty consultant, the internal investment committee action summary, the completeness check. And we've also added, in regards to and it wouldn't be a draft version of the pertinent legal documents, it would be the final version. And we've also added that we would also include the investment and management agreement as applicable. So if we have an investment management agreement with the manager, we would make sure that was included as well. So those are the changes to that subsection. Obviously, probably as far as practice goes, the most substantial change that we're recommending is to that subsection, and that completes the recommended changes. So the rest would remain, the rest of the policy will remain as it's currently written.
Thank you, Mike.
This is Missy. May I ask a question, please?
Yes, ma'am.
Go ahead.
Given that I'm a little new and don't have the benefit of, I understand everything that you explained, but with the current protocol of publishing certain information prior to the investment being made, have you ever, or have you often had occasion where that previous publication resulted in any change with respect to the investment that's being proposed, or has it historically, basically been ratified and made as proposed? I'm just curious how much, if any, change in the direction has been affected by publishing this information in advance.
That's a great question, Missy. There's, as far as the actual investment itself, I can't ever think of the terms or the investment strategy or whether or not we're actually going to make the investment. There has never been, in my memory, any direction that has changed as a result of that. So in essence, every investment has made it through the 3-day review period as presented. But there have been instances where, because we're producing this additional documentation and some of it gets produced, in order to be ready for the 3-day review period, which is more descriptive rather than it is binding as to what the investment is actually about. There's been a couple of instances where, we've had to go back and correct a couple of inconsistencies, but those inconsistencies weren't in any way meaningful, or they didn't have any impact or meaning. It's just if you produce enough documents that are a little bit superfluous, at some point you're going to have some degree of inconsistency. But nothing impacted the investment. We've never halted, we've never made it, the commission's never had to reconvene on an investment, so no, there hasn't been an instance where the actual investment has been challenged.
So theoretically, then this would just bring greater efficiency to the process without yielding a different outcome based on historical experience.
Correct. Yes. And hopefully, and I think it also, I think, better frames what the expectations for the commission are. Because, even though we had this 3-day review period, if you start weaving in considerations about open meeting laws and, things like that, there really would be no mechanism that I think would hold up to legal scrutiny for us to, it's not like the commission can vote on it during the, vote by email or whatever during the 3-day review period. So I think this just gives yes, it creates efficiencies, and I think it gives a much better, clear delineation as to what the function and purpose are in respect to staff and the commission.
Thank you.
Any other questions as to the editing that's been done to the delegation policy?
This is Ron. I just have one general comment about that section E, and that is that having this ability to look at each investment as it's being made is valuable to me as a commissioner, and the executive summary is of course the main thing that I look at, just to sort of remind me where we're going with investments, and so I think it's good to have that notification of investments, so that it doesn't take, otherwise would have to take place at the next commission meeting. So I find it valuable.
Ron, and just to follow up on that, do you think that there's in essence, what we're talking about as far as the change goes is the notification, we we would still provide the executive summary, there would be access to all the documents. It just wouldn't necessarily be before the investment was made. Is that still, I guess, is there a concern with, do you have a concern with, changing the policy where we much more follow what the statute requires, that the notification has to be done within 3 days of closing, or is there some desire to maintain that review period before?
No, I just find it useful as a continuing source of information about where our investments are being made, and so the timing of that, just so it's near the final point, is what's important to me.
Right. Yeah, and I think what you would see from us, wouldn't necessarily I mean, you would still get the same executive summary. You get the access to most all of the same documents, with the exception of, like we talked about the legal sufficiency kind of key terms. But all the information would be provided basically contemporaneously with the investment closing. And, obviously, very adjacent to the time period that we close the investment.
Okay,
Thank you.
any other questions or comments for Mr. Hitchcock? Hearing none, I think it's probably most appropriate if we put off a vote on adopting this update until the next meeting, so all of us have time to read and absorb and to understand and maybe bring further questions before we vote to adopt it. So I think what I'm going to do is table this request for adoption until next meeting. Any thoughts or objections to that from my fellow commissioners? Okay, hearing none, we're going to move along to item number 5 on our agenda, which is the Chief Investment Officer's report. And I now recognize our Chief Investment Officer, Mr. Jeff Berg.
Thank you, Mr. Chairman. If you'll give me just a second to get to where I have control here. Okay.
All right.
All right. You're a tangle of cords here. All right. Good morning, everyone. I am pleased once again to be able to share with you a very strong, not only a very strong fourth quarter, but a very strong fiscal year. We are going to be looking at performance and asset allocation as of June 30th. For the quarter, we earned 6.6% and outperformed our benchmark by 1.5%. And for the fiscal year, we earned nearly 28.6% return, not only well ahead of our benchmark for the year, but roughly 4 times the long-term assumed rate of return. As a result of this return, we are now both ahead of both the actuarial rate and our benchmark over trailing 1, 3, 5, and 10-year periods. So we're very pleased about that. I will call your attention to, on the net benefit payment line, we paid out a net $625 million during the year. And let me guide you through the cash flows for the year, or the value bridge for the year, I'm sorry. We began the year just south of 31 billion, and you can see on the right, we ended the year just north of 39 billion. Inside of that, we saw $4.3 billion of requisitions versus 3.6 billion in deposits. Once again, we had a $110 million legislative inflow, and our investment performance added $8.8 billion to the value, and that is how we get to just north of 39 billion at the end of the year. So this table here shows us returns not only for our asset classes, but also some sub-asset classes. And each of our asset classes outperformed its benchmark during the quarter. I honestly can't remember having been able to say that before. One thing in particular I'd like to note, and it's on this page, but it refers back also to last year's experience. Every single investment or asset class or sub-asset class that had negative returns last year performed extraordinarily well this year. Whether it's emerging market debt, mixed credit, private debt, REITs had a negative return last year, but we're up 39% this year. Listed infrastructure, they all performed significantly above their long-term expected rates of return in what was, in essence, a bounce back year. I want to note here for compliance purposes that we have of course, remained within the allowable ranges as outlined in our AIP SIOP document. So let me move now to our performance analysis. And as is our custom, let's begin by looking at our performance framework. As a reminder, this framework allows us to measure the three main types of investment decisions. First, the decision made to employ a diversified approach to investing as opposed to simply choosing a two-asset portfolio, a stock bond portfolio. Second, the decision that we, the staff, make to deviate from our target portfolio. And then third, the decisions that we make in terms of who we hire to manage the assets of the portfolio. The reference portfolio which is that simple two-asset stock bond portfolio, has continued to perform extraordinarily well in recent years relative to a more diversified portfolio. And that is what you can see in the first yellow box on the left. The portfolio structure decisions during the year were quite positive, as you can see in the center yellow box. We'll dive deeper into that in just a moment. And on the right-hand side, you can see in aggregate, the quality of manager selection, although there's tremendous dispersion, was neutral during the year. So what are the big takeaways for the year? I'll start with what worked well. Our portfolio, and this is very much a rerun from prior meetings, our portfolio was overweight public equity and credit, underweight core bonds during the year. And while we were overweight REITs and listed infrastructure inside of our real assets portfolio, and both of these performed exceedingly well, as you will see as we move forward. In terms of what underperformed, even though private equity was our top performing asset class for the year, it did trail its benchmark, and our private debt portfolio had a fantastic year, but despite the big year, underperformed its benchmark, which is a public markets benchmark that has lagged 3 months. So that benchmark picked up an incredible recovery that began to take shape in the fourth quarter of the prior fiscal year. Let's dive a layer deeper into portfolio structure impacts. The biggest impact in the fourth quarter was, once again, our decision to employ Portable Alpha. The other major impact came from a decision I already referenced, the one to hold REITs and listed infrastructure in lieu of private real estate. Negative impacts here come from, very simply, within our bonds portfolio, we're overweight cash, and there's also a small detracting effect from being overweight private debt, which did not perform as well as everything else did during the quarter. Now, switching to looking at our manager selection impacts, this was a really great quarter across the board. As you can see, our private equity and private debt managers during the quarter posted big returns, which was good to see since, as we've discussed before, I believe we're in about the 5th inning of our turnaround with those portfolios. Our bonds portfolio had a great quarter in addition to managers performing exceedingly well. In March, we made the decision to extend our portfolio duration by adding long-dated treasuries, and this has been a really phenomenal outcome for us as well. Our hedge funds had a great quarter as well. I feel like I've talked about that in prior meetings. The only area where our performance lagged in the quarter was private real estate, but as I'll show you in a few minutes, this is a portfolio that's performed really well for a very long time, so one tough quarter does not begin to concern me at all. Rather than repeating almost verbatim what I just said over the course of the full year, I'm going to keep moving through this, although I will just point out that there is a tremendous amount of blue, which is good for us on this page. Now, I mentioned that every asset class outperformed its benchmark in the quarter, but let's look at a longer period of time. Let's look at 3 years. There's not a whole lot to see in the stocks, in the public equity and bonds portfolios. Those are both very close to their benchmark now on a trailing 3-year basis. But when we look at our private asset classes, private equity and private debt, these are returns that have lagged while we continue to shake off some of those portfolio issues that I referred to a moment ago. And then on the positive side, our real assets portfolio, which you should think of that as predominantly private real estate. This is a portfolio that's performed very well over time. And our hedge fund portfolio, which had a very slightly positive return last year, had a wonderful return this year. The 3-year return is generating nearly 5% excess returns, and that is a symptom that that Portable Alpha is working. Let me shift now to our asset allocation on June 30th. We ended the year overweight equities and private debt. These were positions that we held for essentially the entire year. And these are offset for the bulk of the year by underweights to core bonds and real assets. This is our equity portfolio, and rather than forcing you to find the message here, I think I will cut through all of that. There are 2 messages. One, we're 100% passive, but we do have an overweight, and the overweight is focused in developed markets. In our bond portfolio, we do have continue to have some small off-benchmark legacy positions in emerging market debt and non-investment grade bonds, or what we call mixed credit. We also have a 2.4% cash position, which was a drag during the quarter. And we have this largely because I really want us to emphasize liquidity, given that valuations remain elevated really across asset classes. So we have a little bit of extra material here coming up. I've added a few extra risk slides today because James and I have been spending a good deal of time looking at the difference between our forward and our trailing risk estimates. First, I'm going to walk through what is our traditional look at risk, which is our forward risk estimates. And let me pause here as a reminder, our QSG team, our Quantitative Solutions Group, built this model to use 2 years of daily price market volatility as a basis to forecast risk. But as you know, there is no daily price information for certain parts of our portfolio. So to fill that data gap, what we do is we use public market proxies, and sometimes we even apply a multiplier to calibrate or gross up the risk for certain types of assets. So what you see here is our forecasted risk estimates for the portfolio as it existed on June 30th. To me, the most meaningful observation is the jump that you see in the level of volatility between the policy and the implementation portfolios. There are 3 basic reasons for this. 1, I alluded to, we're overweight equity. 2, I also alluded to the fact that in our core bonds portfolio, we hold some riskier positions in emerging market debt, high yield. And then 3rd, the implementation portfolio includes Portable Alpha, whereas the policy portfolio does not. So now some new material. Let's look at this a different way. What we're looking at here is the volatility of our actual returns over the last 2 years using monthly return data. So our portfolio has changed during this time, and whereas the prior slide we were looking at a snapshot on June 30th, think of this as looking at a movie over the last 2 years. So this is capturing all changes to our portfolio during that time period. The interesting takeaway for me on this page is, and how it differs from the prior page, is that the reference portfolio has exhibited much more volatility than the policy portfolio. In fact, it's had more volatility than each of the other portfolios. And in a way, candidly, that just makes sense to me, because we have seen that the reference portfolio has performed well. And although it's not always the case, I generally expect to see higher risk and higher returns correlate to each other. So let me close with this page. So we're looking at both of those approaches alongside each other here. The data paints two different pictures, and I think it is a very logical thing to ask, well, which one is the right one? Which one should we be looking at? The answer is they're both right. But to me, they're useful in two very different ways. I think that the historical data is much more useful to look at alongside of historical performance when we do a performance review, because it's actually derived from that return stream. It's a good measure of what actually happened. But I think that when we're trying to predict risk or to think about the kind of short or even intermediate term risk implications of a potential portfolio action, I think it is better measured using our forward risk framework. So there's a lot there, but let me pause for a moment and see if there are any questions before I move on to one final topic.
Jeff, it's Ed. What was the number that you gave for the for what we've paid out in distributions to the retirees?
Okay, let me flip back. I believe it was in the neighborhood of 650 million for the year.
Is that the fiscal year?
Yes, or $625 million net.
All right. That,
of course,
that,
more was paid, but it was funded in other ways.
Isn't that down quite a bit from previous years?
Yes, it has been coming down, Ed, and that's been largely a function of the legislation, that the 2017 legislation that began to ratchet up contribution rates. And that is the effect to us that we see, is we are paying out less on an annual basis.
All right, so it would indicate that we've had a positive cash flow in terms of receipts versus payout. Is that correct?
It's still negative, Ed, but it's less negative. So we've had a positive impact on that, but we are still net paying out. Does that make sense?
Okay. All right. Yeah.
And the gap has narrowed basically because of the additional contributions coming in. There's been a substantial impact to narrow the gap between what comes in and what goes out, basically.
And to your question, this is Bill. I'd like to also remind everyone that if we're looking at years past, it wasn't that long ago where the requisition amount was much higher because the Terry program ended. That wasn't that long ago, and so that might be sticking out in some of our memories as to, that outflow number used to be a lot bigger than it is, and of course the deposits are higher because of the matching contribution rates.
Yeah. And Ed, you can see a lot of this in just looking at the 10-year number on this page, and I don't know if you're able to see where I'm trying to indicate here. Over 10 years, the net payout amount out of the trust has been almost $10 billion, which math makes it easy to round, so that's nearly a billion a year. But you can see now over the 1 year, it's down to 625. So there's definitely been some positive impact on coming from that increased funding.
Is the Terry program been totally finalized now? Is that totally paid for? I think original cost of terminating it was very substantial, wasn't it?
I would defer to Peggy on that, but I believe that all funds related to the Terry program have been dispersed.
This is Peggy, and I apologize for my voice. I've had a little bit of laryngitis this week. But yes, all the payments were paid out at the end of 2018. The Terry program closed June 30th, 2018.
Okay.
Thank you.
All right. Are there any other questions about the performance or risk update? Okay. Well,
Jeff, this is Bill. I do have a question. Is
sir.
on that last chart you were on comparing historical to future risk, the future risk or the forward risk always was higher. Historically, is the forward risk always higher, or is there or not so?
That's a good question.
Maybe that's a dumb question. I don't know. Tell me if it is.
No, it's not. It's not at all a dumb question. But I don't know that I can answer. You know, is there a circumstance in which the forward risk would be lower? Because we are basing our kind of near-term risk estimates on recent experience. So I don't know that I think it would be a very surprising outcome to have the historical risk be higher than the forward risk. But James, I believe James is on. I would defer to him as our expert on this. So James, is there a circumstance in which you can imagine the historical risk being higher?
Yeah, that's actually, that has not been the case in any observations that we've seen when we look at this over the past 25 years or so, Bill. So it's a good question, but that's not something we've seen. And part of it comes down to the fact that we're really trying to capture the economic risk in some of the private market assets with the public proxies, which do tend to exhibit higher vol. So that's the short answer.
Well, and James, just to be clear, the proxies would, you know, especially if you're employing a leverage effect, it's the proxies that would experience higher vol, and then but the realized vol is a lot of times where you would necessarily get the difference because of how, you know, private markets assets mark and the frequency by which they mark, right?
Absolutely, that's correct.
Does that answer the question, Bill?
Yeah, it sure does. And I ask it, and I don't know that there's an answer to this question either, but I ask it in the context of thinking about looking at these forward risk numbers. It says the value of diversification increases our risk, or diversification increases our risk. Versus historically, it really might not. But of course, the general concept, you know, that I understand, and I think we actually state in our SIOP is that diversification does provide value. So I guess that's kind of where I was headed towards, is this telling us anything about the value of diversification?
Yeah, so well, that's a good question. So Bill, I would answer that this way. One, looking at forward risk, you know, what we expect over decades, and this serves the basis for how we determine the reference and policy portfolios. If you recall, they're supposed to have very similar levels of risk. So we would expect them to exhibit similar risk levels over very long periods of time. I do not expect, however, that will hold constant over shorter windows. You know, and we're looking at essentially the last 2 years here. I harbor no belief that it is always going to look like those two have the same levels of risk in a historical sense. But I do think that as we, the way that we are approaching risk, the other thing I would say is, woe be unto anyone who projects lower risk than is responsible to do so. You can create real meaningful problems by underappreciating the risk that you take. So I hope all of you take some comfort in realizing that we are trying to have a very eyes wide open picture of risk here, and we are not by any stretch of the imagination suppressing our forecast of risk. If we were showing you numbers that were very subdued as our forecast, I think that would create additional and very appropriate questions. We need to be fully cognizant of what curveballs markets can throw at us, and that we are trying to do so. Not only with respect to how we think about public markets, but in particular how we model private markets.
Thanks, Jeff.
Okay, thank you for the question. All right, Mr. Chairman, I'd like to do one thing that is maybe a little bit off script here. I have news that I want to share with the commission that is very bittersweet, and I'll just get straight to the point. Steve Marino is going to be leaving us in November. He has accepted a private sector job with a firm that is developing an institutional quality credit platform. For clarity, this is not a firm that we are invested with. I don't know how many of you know this, but Steve joined us in 2013 when he quit a full-time job to take an internship here. I guess that's the definition of betting on yourself. In his time here, he's worked on and touched a lot of areas of our portfolio, from public equity, mixed credit, GAA, equity options, private debt. We ultimately asked him to run our private markets team, where he's just done a fantastic job for us. He's been a great thought partner to me personally and others on our team on a whole host of projects. He's great, really, really great at giving feedback. And even when that feedback is not what you want to hear, it's always been really thoughtful and very much worth paying attention to. So he's going to leave in a couple months. He's going to help us transition his responsibilities over the course of the next 2 months. And while he'll be with us through November, unfortunately, this is his last commission meeting. He's had a big impact on our plan and our staff. And over the past couple of years, he's had a lot of interaction with each of you. And I wanted to be sure to share this news with all of you. And although we're sad to see him leave, we're very excited knowing that he's going to succeed at anything he puts his mind to. So I just wanted to make sure I shared that with all of you. So, Mr. Chairman, this concludes my comments.
Well,
Jeff, this is Ron.
Yes, sir.
I just wanted to point out about Steve, in addition to how valuable he's been to the commission, and he's been great for us, but also that a side benefit is that he's been of value to the Business Partnership Foundation at the Darla Moore School of Business. And so his outside public service is appreciated also. Thank you so much, Steve.
Very much. I second that. So we will hear from him in closed session, but I just want to make sure that we expressed our appreciation openly.
all right. Thank you, Jeff. Steve, happy for you for your good news. Sad for us that you'll be leaving us. Look forward to hearing from you a little later on in today's meeting. Next up on the agenda, item 6 is the delegated investment report. And I believe that comes back to you, Mr. Berg.
Yes, Mr. Chairman. This is, as is our custom pursuant to the delegation policy. You have all seen memos on each of these investments, so I do not intend to go into detail, but we do, for compliance purposes, share the amount and nature of investments that we have made between meetings, and this is what you see on the screen before you. So I won't go into detail, but happy to entertain any questions.
Questions for Mr. Berg involving the delegated investment report? Hearing none. Next item on the agenda is for us to go into executive session. Mr. Hitchcock, can I get you to read that motion for us, please?
Motion to recede into executive session to discuss investment matters pursuant to SC Code annotated 9-16-80 and 9-16-320, to discuss personnel matters pursuant to SC Code annotated sections 30-4-70A1, and receive advice from legal counsel pursuant to SC Code annotated section 30-4-70A2.
May I have a motion, please?
So moved.
Thank you. May I have a second?
Second?
Second.
Thank you. Any discussion before we vote on whether we receded to executive session? No. All in favor, please say yes.
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 Any opposed, please say no. Thank you very much. Motion carries. We are now receding into executive session. Any other business before the commission today?
No, sir.
Being no more business before the commission today, unless we have other comments or questions, I'd call for a motion to adjourn.
I think Mr. Williams already got you.
Reynolds, you jumping ahead in line?
I'm always first on this one.
Okay, so we'll take that as Mr. Williams has moved to adjourn. May I have a second, please?
Second.
I have a motion and a second. Any discussion? All in favor of adjourning, please say yes.
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 Anyone opposed? We stand adjourned. Thank you very much, everyone.
Thank you, everyone. Thank you very much.